The last item I want to talk about in this module is inventory. Now, inventory is a little bit more complex than some of the other items we've been speaking about before, and there's a number of issues with inventory. The first item with inventory is, in actual fact, how do you account for it? Now, again, this can be confusing, and it's about accrual accounting. And again, a lot of non-accountants can sometimes get confused by thinking that inventory is an expense when you buy it. The first important point to note is inventory is an expense when you buy it. When you buy inventory, you're actually obtaining an asset. The expense associated with inventory, which is called cost of goods sold, actually is only recognised when you actually sell the inventory. That's why it's called cost of goods sold, not cost of goods bought. So if you look at the slides, we've got a little example there where a company purchased 100 tables for $10 each on the 1st of January, then they sold 80 tables for $18 each on the 10th of January. Now, on the 1st of January, you can see that the accounting transaction doesn't affect the income statement or the profit and loss statement at all. In actual fact, on that date, your cash goes down by $1,000, the $100 to 10, but your actual another asset being inventory goes up. There is no expense on that date of the 1st of January. The expense is on the 10th of January when you sell the inventory. So we sell those 80 of those tables for $18 each. 80 lots of 18 is $1,440. So in that situation, or I'm assuming here everything was done for cash, your cash goes up by $1,440. And that is sales revenue. So we'd recognise that in the income statement as revenue. At that date that you also say, well, we've also lost inventory. The inventory goes down by $800, being 80 lots of 10. There's the 80 tables, but the inventory goes down by the $10 per table, not the $18 you sell them for, but the $10 it cost you to buy them. And that is recognised as a cost of goods sold expense. So in actual fact, in the income statement, we have revenue of $1,440 and cost of goods sold of $800. The difference is $640, which is your profit, but the profit is based on the time you sell the inventory, and it's based on the cost of the goods you sold, not the cost of the goods you bought.